Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is Brad Roth, who is the co-founding principal of Thor Analytics and the chief investment officer at Thor Metals. We are recording this episode in January of 2020, and boy, is it a timely topic. We are going to discuss metals and their place in portfolio construction. Brad, thanks for coming on.
Jay, thank you so much for having me.
All right, so we've had this interview in the pipeline for a while. It's just incredibly timely that we're recording it today, January 3rd, after all the geopolitical risk we've seen, the upward pricing pressure in metal, in gold in particular, over the past year. So I'm glad we're going to go deep on this. But let's start with a little bit on your background. Could you give us a high-level overview of your industry experience?
Sure, yeah. And again, Jay, thanks for having me on. I started my career in high net worth consulting and kind of sitting in a seat typical to maybe a lot of your listeners who are RIAs or, working in the wealth management space. Although I was always interested in trading, I had an opportunity in 2014 to join a group called Sardonyx Capital, which was a hedge fund, mostly trading ETFs, both long and short. Which has evolved now into Thor Analytics and most recently the launch of the Thor Metals Fund, which is a hedge fund that is geared towards high net worth investors as well as RIAs that trades futures contracts of the metals, both long and short, to try to take advantage of the volatility in them.
Okay, excellent. So longtime listeners know that I have fairly strong opinions on the place of metals in portfolios. So I'm really looking forward to diving into your process and your thought process around that. But in your view, why should advisors and their clients consider adding metals to their portfolios if they don't already have them?
Sure. And let's talk really specifically about gold. Gold is a great diversifier. If you look at most portfolios, there's really only three asset classes: stocks, bonds, and cash represented. And gold can be just a wonderful diversifier because it's really not correlated and highly negatively correlated to a lot of asset classes out there. And so it can act as this great diversifier inside of the portfolio. So that is why, outside of a couple other reasons, why somebody would want to add very generally gold to their portfolio. But if we get into it a little bit deeper, gold really acts well during, we'll call them black swan events or kind of left tail events where, we're talking about financial crisis, or we're talking today about, some things geopolitically going on. Gold tends to outperform during those times. It can act as a great hedge to your overall portfolio.
And really, Brad, where the rubber meets the road is how do you allocate to gold? And let's stick with gold. We can come back to the other metals later. If an advisor wants to allocate to gold, they have ETFs, futures contracts. Go buy some physical gold from the pawn shop and bury it in your backyard. Go buy it from an organization that will buy the gold and store it for you. What are your thoughts on the different ways for advisors to help clients allocate to gold?
Sure. Well, the old Wall Street saying is put 10% of your money in gold and hope it doesn't work out. And there's really a handful of different ways to add gold to your portfolio, all of which you've mentioned. Now, ETFs being the easiest to get exposure, we really prefer to use the futures contracts because you can get a larger position size with less cash to outlay. So really, you can get 100 ounces of gold, which is trading at today $1,500, for really a fraction of the cost it would be to buy the ETF. So you don't have to allocate as much money to get the quote unquote hedge on by using futures contracts, but I totally understand the ease of use and the ability to just tackle GLD and put it in the portfolio and have that as a hedge as well.
What are your thoughts on physical gold?
So we don't have a whole lot of experience holding physical gold. It can be very expensive to store. There's a lot of logistics that go along with it. So we prefer to kind of trade the financials. It acts in a very similar way. So our expertise does not necessarily lie in holding physical in the direct precious metals themselves.
Yeah, and there are challenges that come with holding the physical as well as opportunities, but the challenges really come when you're looking at allocating to it inside of an IRA, because the accountability for it, if you are using it in some type of stored custodian fashion, the IRS is really starting to crack down on it. I've had some clients reach out to try and find some storage facilities for their clients that own physical gold, because the IRS wants accountability and they're going to want their RMDs, which really speaks to these futures contracts or ETFs being a better way to allocate to it for portfolios.
Yeah, I totally agree. And the physical does bring in all of those different aspects that makes it a little bit more difficult. So we're seeing advisors do mostly across the board is buying, the ETF and having that allocation in there as a long only exposure to gold. And there are some more sophisticated advisors that will use the future.
So where do you see over the next 12 months? And I think I'm asking you to predict here a little bit. And we're not big fans of that on the podcast, but over the next 12 months, where do you see the benefits to owning gold?
Sure. And it's funny you say you're not a fan of predicting. We just started working on a piece called The Plunders of Prediction. So that'll be coming out here shortly. But really, we see gold, we see everything going on in the world right now. And at Thor Analytics, we're not in the business of predicting. We are fully systematized and computerized traders. But to answer your question, we see, gold had such a strong year in 2019. We're seeing some people flock to safety a little bit in the precious metal space. So I believe that we will continue to see some strength as well as some volatility in gold specifically.
Well, it also gets back to the hedge against the black swan event you mentioned earlier. And as tensions build up everywhere, it could provide that insurance that Wall Street's always thought made sense for a portfolio to have. I look back at my initial gold research, and it goes all the way back to looking at Harry Brown's portfolios from the 1970s. Are you familiar with Harry Brown?
I'm not.
Okay. I should have asked you about that before we started. Harry Brown was a libertarian presidential candidate and ran an investment firm. And his simple model was the basis for what Ray Dalio and Bridgewater do. And they hypothecated in the early 1970s that if you built a portfolio of 25% gold, 25% U.S. equities, 25% long bonds, and 25% cash, and rebalanced it systematically, you could manage through the volatility of what he thought the inflation that was going to come through the 1970s.
Right.
And sure
right.
enough,
And that's
that
right.
worked through the 1970s. And then in the 80s, it struggled some. In the 90s, it was kind of up and down, as it has been for the last 20 years. But it was that diversification and rebalance with the metal in there that worked. And that's what Dalio has found with Bridgewater.
Right. And yeah, I mean, that's one of the great spaces where gold tends to work is highly inflationary periods. We haven't had inflation. The Fed has done everything they could and are trying to boost inflation, which gold tends to significantly outperform in those periods. So again, that's looking at what Brown did. I mean, he added the fourth asset class to the portfolio, which is it is a diversifier, and it's a great diversifier to put to use and to act as a hedge when things go wrong or you see higher inflation or a lower U.S. dollar.
And really bridging what Harry Brown did to what the folks at Bridgewater do is really the use of futures contracts to gain that exposure. Besides the leverage that comes with using futures contracts for gold, any other benefits, Brad?
Sure. I mean, as a long-term investor, if you are a long-term investor, there's really, other than getting the leverage, not a ton of additional benefit. However, if you're somebody who's more active, the futures contract in gold is open 23 hours a day. And, a lot can happen when markets are closed. Not to get too much on current events, but, a geopolitical event happened overnight, which sent markets down and gold soaring. And if you wanted to invest in GLD when that happened, it would be very difficult for you to get your position on. And, the futures markets being open as often as they are allows a trader or an investor to gain exposure and get the full amount of exposure they want really at all times a day.
23 hours a day. I was not aware of that. What hour is it closed?
So it closes 5 p.m. Eastern Standard Time and reopens at 6 p.m. Eastern Standard Time. So you got 1 hour of settlement there.
Gosh, so in order to capitalize on that, an advisor would really have to leverage technology and some type of systematic plan. I know your firm does a lot of work in that space. I can tell you, in my consulting practice, I have not run across a lot of advisors leveraging technologies to improve their outcomes, particularly in gold and other alternative asset classes. Why do you think that is?
I don't know, really. I think there's just a slower adoption into the use of technology. Now, we've seen technology being used a lot. However, you don't really see it too much in the RIA space in terms of coming up and generating investment decisions. There are some folks out there that do it and do a very, very good job. And we have utilized full automation and systemization since I've started this in 2014. So it's really, really a wonderful thing. It removes the number one detriment to returns, which I believe is emotion. But the second thing it allows you to do by utilizing systemization and automation and having access to markets that are trading. I mean, this world has gotten so globalized and everything is so interconnected that things can change overnight. And if you're not able to take advantage of those while you're sleeping and having a process that's able to act on those decisions, then you really can miss out on a lot that goes on in the market rather than just, having your eyes on the screen between 9:30 and 4.
Listen, Brad, I'm really curious to the degree that you're able to share it, and this podcast still be compliant friendly. Tell us, how does your technology work to deliver those types of outcomes?
Sure. Well, we have a decision-making algorithm that decides whether or not we should be long or short a futures contract, and whether that's gold, whether that's silver, copper, treasury bonds, currencies, whatever has a liquid market. We have a decision-making tool to be able to understand whether or not we should be long or short that asset or security. Now, secondarily, we've spent a lot of time and a lot of money making a decision-making function to be able to execute those trades. So within milliseconds, once a decision is made, that order gets routed directly to our broker and is executed instantaneously without any human intervention whatsoever.
Huh. So is this algorithm something that you guys build and then you change based on change the outcomes based upon what you see going on during the regular market hours, or is it something that you're setting and forgetting and it's your black box?
Sure. Well, and that's really a two-part answer. We've built the algorithm itself is dependent based on what security or asset we're trading. So it has different parameters based on the historical success, long-term historical success of each asset we are trading, and that stays stagnant. So the decision-making doesn't change because of current market events whatsoever. We look at the whole history as far back as we possibly can go and say, what has worked over all cycles? What has been successful? You only need a hammer to put a nail in the wall. You don't need something fancy that changes all the time to just get that job done. And so we really subscribe to that, where we want to build something that's extremely robust, that's going to be able to perform during all market cycles, but really tailor it to each asset that we're trading. Even if we're just talking about the metals, gold trades very, very differently than copper and also silver. So we wanted to look at the historical volatility metrics of each asset class and tailor the algorithm to what to its best possible outcome over all different market cycles. And then we just let it run.
Okay. So when you look at what you're seeing develop in the high net worth space and the folks that are leveraging alternative investments, what is it that you think advisors should be paying attention to that you find most of them are ignoring? Because you've got a great view into that.
Sure. And we talk to large RIAs and wealth managers all the time. And one thing they're trying to find is differentiated alternatives. There are so many alternatives out there that are doing the same thing. There's so many long short equities. There's so many, long short, equity futures funds out there that, all really have failed advisors over the last decade or 20 years. So what we're talking to a lot of advisors about and why they're coming to us is they have very niche and specific needs that they would like solved for. And Thor has the ability, because it's built an algorithm that could look at different asset classes, is to solve for those needs. So the Metals Fund itself actually came about not because it was something that we were, building for the public. It was a very large RIA who said, look, I have this need, and a lot of my clients, need exposures to metals, but for the vast majority of time, metals can be a drag on portfolio performance, and how can we make it more productive? So he didn't really want to, run the fund himself. So we built the fund for him, and his clients can utilize it. So that's what Thor has enabled us to do, is solve RIAs and wealth managers' problems to build niche strategies or holes in their alternative investment space or diversifier space to give them some hedging components or some things that might be extremely unique to their firm and for their clients that they may not be able to get elsewhere.
That's great. Brad, how could listeners find out more about Thor Analytics?
Sure, we can go to our website, thoranalytics.com. We love talking to people, so get on there, schedule a demo. We'll jump on with you for 45 minutes or an hour, explain the process in depth and try to answer any questions you have. So just check out our website, thoranalytics.com.
Excellent. Brad, thanks so much for coming on the podcast.
Hey, Jay, thanks so much. You have a great day and happy 2020.
The information provided is for educational and informational purposes only and does not constitute investment advice and should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult an attorney or tax advisor. Resilient Wealth LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Resilient Wealth and its representatives are properly licensed or exempt from licensure. For Resilient Wealth information, please visit Investment Advisor's public disclosure website at www.advisorinfo.sec.gov by searching Resilient Wealth CRD number 30